Is mistakes that I've seen people do, and also mistakes that I have made as well, and ways I've improved, and just certain ideas to add to the toolbox to improve your shorting as well. Of course, I'm going to first of all just talk about it first, and then I'm going to go on the charts as well to give more examples. So one of the common mistakes I see is that people treat key levels rigidly, as that key levels are very subjective, right? One person can draw a key level here, another person might draw a key level below that. When sometimes people see a huge run-up, and they assume that because they've drawn a line there, that it has to stop and then reverse. So, key levels are very subjective. And some traders actually draw boxes as well, just to indicate supply zones and demand zones. So the next thing I see is sometimes people, they look at RSI, and they assume that just because RSI is oversold, that it has to reverse immediately. And that's not necessarily true. When RSI is in an overbought territory, it generally more means that there's an intense buying pressure. It doesn't, by any stretch of imagination, necessarily mean there's going to be an immediate reversal. I'm going to use this example on the 1 hour chart. So, RSI peaked here, then it dropped, right? But the price still went further up. Of course, RSI is useful on larger time frames, especially like the 4 or the weekly, and I would definitely take that seriously. But in this case, it's just to highlight that you should see it as a tool. Do not make trading decisions purely based on an indicator. Indicators have to be combined with key levels, and you need to get various other key confluences, really, as well. And that brings me to my next point. Sometimes people trade purely based on indicators, and everything has to be combined, and it's about developing a system in which you can develop confluences as well. So, for example, in this case, the MDX Oscillator 5 is an indicator that I really love. I've actually put a link in the description if you want to check it out. But everything has to be used with confluence. So in this case, the MDX 5 Oscillator was overbought, right? We had so many hits, especially in the 1 hour as well. But if you had shorted blindly, you would have got stopped out here. You would have got stopped out here. Get stopped out here as well. So you have to always combine indicator signals with key levels. In this case, I have drawn this key level based on hit past historical performance. So rather than taking and also the way I draw key levels is generally speaking. So for a key level, you generally need 3 hits. You need 1 hit, confirming that it's a key level. Then you need 2 other hits to sort of support that it's definitely a key level. Of course, key levels are very subjective, and you don't see institutions, sitting on the desk with legs on the table and opening some beers and looking at key levels. They use, of course, things like volume profile, order flow. They're really looking at the habits of retail traders. But I generally tend to take signals from key levels as opposed to into key levels. So I know this might be obvious for some people, but just to revisit this. So if I had a long signal here, right, and if I take a long, it's going right into the key level. So it's like you're taking a signal into a brick wall. Obviously, it can go up, but I always try to look for the high probability, high risk reward setup, really. In this case, we charge right past. Yes, it's nice to draw key levels, but don't be rigid about it. It's just rough zones, really. And you might get a signal that's overbought or oversold, but a signal can stay overbought or oversold much longer than you can remain solvent. So it's just always important to combine signal levels with your own analysis and don't take them blindly. The next thing I see is that people short support or long resistance. And this is quite, again, straightforward for some people, but initially when you're starting, it can be difficult, right? So there's generally 3 steps. The first step is you long support, right? The second option is you short resistance. The third option is you do nothing. You wait for a breakout. And you're probably wondering which of those is the hardest for people, but I would definitely say doing nothing is the hardest. Trading can be addicting sometimes, because especially it's like when people take a lot of caffeine, right? It's addicting because of the dopamine you get. It's the same with trading. Sometimes we find it difficult to sit on our hands, right? We sometimes think, oh, we're traders, so we have to force a trade. If you're at a place where price is very stagnant at support and you think it's going to go down, so it's quite often risky to short that because it's at a key support level. So in this case, we were at the zone here in the 20k region for a while, actually for a couple of days, and people were like, okay, it's definitely going to go down. I'm going to short it. But why not do nothing and sit on your hands and wait for the breakout and then short the retest of 20k once it happens? That, in my opinion, is a much higher probability setup. It's always better to react to the market rather than predicting the market's moves. And the next point I want to talk about is poor psychology. People constantly want the dopamine of being in a trade. And sometimes we have to have that emotional control of sitting out trades, and just to help our psychology. Sometimes we lose a trade and we want a revenge trade to compensate. But what I've learned is that someone can place 4 trades in a month and definitely outperform someone that places like 100 trades in a month. Sometimes less is more. Sometimes it's more about taking those high probability setups, and that you can actually yield a lot more. Because we're always taught that you have to work hard for money. You have to work hard for results. But trading is a bit different. You have to work smart, not necessarily work hard. Sometimes I find personally that one week there are many opportunities. I trade 3 to 4 times, 5 times, because I'm more of a swing trader. I use the 4-hour, 15-minute combination and 1 hour as well. But other weeks I place no trades. You cannot force trades, really. I'm sure you guys have all, heard about this. You get that phone call from your friend and they're saying, hey, did you notice that Bitcoin has dropped? We should probably short now. And when you get that phone call, very often it's too late to short because the move has already happened. You don't want to short a falling knife that has already happened, right? And it's just all about taking a step back and to always remember that there's always a trade for another day. I know it can be difficult with combating that FOMO, but especially in your initial years of trading, but it's just, having that realization, and there's ways to combat it. For example, putting alerts at key levels on TradingView. That's what I do. And the stop loss is also overlooked, and stop loss management is so important. Sometimes people just constantly keep adjusting it, right? They have no regard for market structure. And so it's a fine balance as well when shorting, really. A stop loss is not what is the maximum money I can lose. No, a stop loss is more at which point do I accept that I'm wrong in the trade. My approach to stop losses, especially for shorting, is that I'm putting my stop loss in such a place that if it gets taken out, market structure would be broken and there would be a continuation of that initial upward move. And the next point I want to make is poor risk management again. People just over leverage. They use shorts. Sometimes people are shorting. They're so underwater that they think, okay, I'm going to scale in. I'm going to scale in and increase my average for shorting. And sometimes the market can go much higher when you're shorting than you will remain solvent, right? There can be a short squeeze. And this is why I always use stop losses, calculated stop losses, precise, because it's better just to, get stopped out and move forward. There's always a trade for another day. And there is a tendency for people to think when they start, once I start making big gains and home runs, then I will use proper risk management. But I disagree. You have to start using the risk management properly initially, and then the income and money will follow generally. And if you think about it, if you can't manage $1,000 sensibly, how do you know you're going to manage 100k sensibly, $1 million sensibly? And sometimes we short and we make huge gains and we just get overconfident. And this can change you as a person, especially if you've come from a 9-to-5 job and you see the screen and you see a huge amount of gains. But you need to realize that there's winning streaks and also losing streaks. And ultimately, it is the consistency that matters. And it's just about not getting too excited when you've won a trade and not getting too unhappy when you've lost a trade. It's just trying to have that emotional control and staying neutral. But a lot of that does come with time, really. So now I'm just going to talk about certain ways to improve shorting as well, and I'm going to go a bit more on the charts. There are certain times in which shorting is statistically more likely to be successful. So ATR is the average true range. And the way I calculate this is I look at so this is the current day. Then what I like to do is I like to look at the difference between the highs and lows of the previous day. So in this case, it's 406. I'm just putting that into my calculator. The previous day before that is the difference between the high and low is 1,129. The previous day before that, the difference between the high and the low is 273.5. The previous day before that, it is 773.5. So I'm just putting that in my calculator. The previous day before that is 361.5. So I've got my total, which is 3,403.5. Then I divide that by 5. So I've got 609. Okay? So the average ATR for the last 5 days is 609. So why have I done this? So in a year, there are 360 days, roughly. But in terms of calendar trading years, there's 270. Because naturally in equities, the weekend is closed. So first of all, you mark the daily open, right? So in this case, it's here. This is the current day, by the way. The principle goes that once you move 50 to 70% of the average ATR of the last 5 days, you're 85% more likely to be successful in the trade by going counter to the trade. So in this case, for example, the daily open was 21,295. As my calculation was such that the average ATR of the last 5 days was 609. So half of 609 is 304.5. Okay, let's just say 305 for sake of ease. So say we move down 305 from the daily open. Okay, so soon price gets down to 20,991, which is 305 points in the daily open, right? I would only be interested in counter trades, so in this case longing or doing nothing. Because statistically, 85% of the time in a calendar trading year, once price has moved between 50 to 70% of the daily open, you're 85% more likely to win the trade by going counter trend rather than going trend trading. If you mark the daily open, okay, so in this case it's roughly 21,300 roughly, and if you bring it down to 305, that's roughly 50% of the average ATR of the last 5 days. If you move it down to say 70% of the ATR, so in this case if you move down 426 points roughly, that's 70% of the average ATR of the 5 days. So that sounds quite long-winded, right? But it kind of, some people might view this as common sense, but I find it very useful sometimes when the market makes huge run-ups on certain days, because sometimes it's difficult to kind of gauge what the average behavior of the instrument is, right? So in this case, we're looking at Bitcoin. And so, for example, if price makes a huge dump from the daily open, right? Yes, you can short, but once price has moved so much down, for example, between 50 to 70% of the average ATR of the last 5 days, the actual likelihood of it going further down becomes less because the market only has a certain amount of fuel each day. Yes, price might take a pause, like a breather, and then go down the next day. Yes, of course you have these kind of really long candles, which probably double the average ATR of the last 5 days. But again, I told you it's statistics, right? So 85% of the time, once price moves between 50 to 70% of the average ATR of the last 5 days, you're 85% more likely to win the trade by going counter trend. Obviously, you would use other confluences and you wouldn't trade blindly off this, but it's just another toolbox to add, especially when trying to help your ability to short. So imagine price had, we had opened here, right? Imagine price now goes up, say 500 points. I mentioned the average ATR of the last 5 days was 609, so that's definitely more than 80%, right? You wouldn't naturally long here. Yes, it might go up, but you're always trying to look for the high probability setup. What I'd rather do is do nothing, sit on my hands, or look for a short if there was other indications. So the ATR calculation rule, I based it on the average of the last 5 days, mostly because markets have changed so much, and this does work as well. Some people like to base the ATR calculation based on the last 14 days. You can do that, but it's just a bit intensive, and I just feel it's not necessary. And quite a few traders actually use ATR on the last 5 days because it just takes into account more recent price action. Yes, I've drawn key levels, but sometimes I always talk about areas of demand. For drawing a box to indicate areas of demand for support, what I like to generally do is I like to draw a box around the preceding candle before the upward momentum change. People often assume that the areas of demand correspond to, the preceding red candle before the upward momentum, but that's not necessarily the case. Sometimes you draw the box around the preceding candle that's green. The whole idea is, the way I was taught, is that it has to be the preceding candle before the upward momentum change. So in this case, there's an area of demand here. So price might come back to this area of interest or order block, but it does not necessarily have to. But I would be interested in, potentially taking a long here if we do. Or in the case of shorting, an area of supply is pretty much the opposite. So it's the preceding candle before the downward momentum. So in this case, I would draw an area of supply here, really. So I'm just going to make this red. Actually extend it up here. In this case, we had this huge run up from here to up here. Then down the preceding green candle before the downward move in this case is this one here. So I've drawn the box around here. So in this case, we had this run up, had this hit here, we fell down. We had this run up again, hit here, and then we fell down. So this is an area of supply. It doesn't mean it's going to stop magically all the time, but it's just an area of interest. As I always talk about key levels, when a key level is hit 3 times, generally speaking, I'm more confident it's a level. But when it keeps being hit 4, 5, 6, 7 times, I get a bit less confident. But yeah, it's just to highlight that sometimes try and treat key levels as a zone. Yes, you can draw lines just to help your illustration, but don't be rigid about them. Another point that I want to talk about is, again, I talked about this earlier, is that reactionary trading as opposed to predictive. So sometimes we have a big run up like this, right? We had this huge run up here. We fell down with this huge run up here. It's very difficult to predict the top to short. And in this case, you can argue this is actually a false break. Also, what I've learned with shorting is that rather than predicting this top to short, I always like to look for a break of structure on the 4-hour and then enter on the 15-minute, because you don't know how high the price can go. If you flip the chart over, invert it, in my opinion, picking the top to short is equivalent of trying to pick the bottom to long. As you know, by now it's quite difficult to predict the bottom. Say price keeps going down, we can't really say for sure when it's going to stop. But for me specifically, I prefer rather to buy in and long when there's a momentum change, a clear momentum change, at least in the lower time frames. But just to illustrate that, sometimes when you've had a huge run up, sometimes it's good to wait for a break of structure in the 4-hour, or maybe you might want to use the 2-hour. Look for that lower high, and you can also supplement that with key moving average crossovers. For example, I like the Fibonacci ones, like 21, 34, 55, and see how those interact. Always look for 3-5 confluences. Have a system that works for you, really. So for me, I always like to have 3-5 confluences for shorting. I'm trying to build up a case to say, why should I short this? And you just find out what works for you, and of course, journal and record it. So for me, in this case, I caught a really good short here, down from here to here. And for me, I noticed that, for example, first of all, we were hitting a key level, so that's 1 point. Second of all, we had some bearishness on the MDX 5 indicator. On top of that, there started to be some key moving average crossovers on the lower time frame. And also BBWP as well, I look as well. I'll briefly explain BBWP. Maybe you might like it. It might be another tool you want to add to your toolbox. But this is a volatility indicator. And it doesn't measure top and bottoms. It measures the volatility of price. And it's more reliable generally, I find, for 4-hour, daily, weekly, and for those higher time frames. I've back tested it across 5 years. It's actually really good. It's less reliable on the 1-hour. So this is a scale between 0 to 100 for BBWP. And in areas of red, or when price gets to in the high 90s, that indicates areas of high expansion, right? So in this case, if you notice, we had this huge run up, but in this case, the BBWP roughly indicated that expansion had almost peaked. And in this case, the direction of expansion was upwards. So that to me suggested, okay, we might be near a certain period of cooldown, and we might need to go into a period of contraction. If you mark here the highest point, 100% in BBWP happened around here. So this was roughly the top, and then we had a period of cooling down, and we went down. As you can see, it went from expansion down to contraction. And these areas of blue represent periods of contraction. Whenever the BBWP is in the low teens, it generally indicates contraction. Again, just to reiterate, these indicators do not represent, local highs, local bottoms. It just more represents local areas of expansion, local areas of contraction. Right? And during periods of just low volatility, what happens is that we go into the period of contraction in the BBWP. So here, this was a period where we were just dancing around for a long time. Not very little was happening. And the 4 BBWP as well, we were just really highly contracted. And as soon as we started having a downward move, BBWP started going from period of contraction to expansion. And again, just to highlight, although we're expanding here, in this case we went down. So just to reiterate, this is just more an indicator of expansion, contraction, but it can be combined sometimes to roughly gauge if we are somewhat near a local bottom or just a local high based on some volatility really, but you cannot use it on its own. But it's just another tool that I use. Next point I want to talk about is people don't consider the false breaks and true breaks. There's different types of false breaks for shorting you need to consider as well. There's a complex false break, there's a simple false break. It takes experience to master that, but it's probably beyond the scope of this video. But in this case, this was a false break to me. And this is why I shorted here actually. Because we had this huge run up, right? And you need to understand the dynamic of how price works and the dynamics of traders. So I marked out this horizontal ray from 19.9k-ish because that was a local high. So I thought we might go back down. You need to understand the dynamics of traders. Okay, at support you have traders who are buying support to sell the resistance up here. And once price goes from here to the resistance, what people who buy support to long do is they close the position. And sometimes they might open a short. On the other hand, you also have people who play the breakout. So true break traders. Once price goes here, those breakout traders will open a long position. Right? Overall, you have this interesting dynamic where you have breakout traders who play the long card. Right, and then you have people who've long from here who take profit to close the position, and they might open a short. And so what happened is sometimes price overextends, right, and you get this false break. This is another point people make a mistake with shorting. Just because price has gone up like this past a previous resistance, it does not mean that we've actually broken structure yet. Because if you notice, yes, in lower time frames we might have gone above it. For example, the 1 hour, 5, 15, and 5 minute. And you might see indications an actual true break, but this is an example, in my opinion, of a simple false break when you go into the lower time frames as well. We've kind of had this wick of emotion and we've come back down. So the way I played it was, again, I'm not trying to predict the top to short because it can go much higher. I'm waiting for price to go up, then come back below the key level. And so once again, I'm taking my signals from key levels, not into key levels. If I'm shorting from the top here into here, that's like me shorting into a brick wall. You can do it and it might work. But what I find from experience, a high probability setup is to wait for price to go up, come back down into the key level, and then short from the key level when you get an indicator signal that you like. And I shorted from here, and a bit of a tight stop loss. I put it at 2100, and then I shorted it. It was a nice 1-to-4 risk-reward ratio trade. I took profit around here really. I didn't catch the exact bottom, but I got a wonderful risk-reward ratio. Yeah, I will talk about false breaks a lot more. It is a complex topic because that was just a simple false break. There's also complex false break. When you have significantly more than one candle closing above the key level. Just because price closes above a previous resistance, it doesn't not mean that it's a true break. It could just be a false break. And when you see a lot of action above a key level and you're using the smaller time frame, often it's useful to zoom in to a higher time frame and just look at the bigger picture really, because it might just be a wick. Another thing to also consider is the long and short ratio as well. If everybody is short in a market, you can look at various things. You can look at CoinGlass is quite good. For example, you can see the different exchanges, the habits of shorting, and if everybody is short, then that means the market has a lot of fuel to go up because the market makes the fools out of most of the people. If everybody was right, then everyone would be wealthy, right? But market makers have to screw people over, right? So in this case, in the 1-hour, everyone is overall as a net, we are, net short really. So perhaps the market might go up, right? And it could be the inverse. If everyone's really long on the market, then the market, there's fuel to go down because the market makes the fools out of the majority, of course. And I also like to compare different exchanges. Generally speaking, more retail traders who are less experienced would use Binance. More advanced traders might use things like FTX or Bybit. There's also Bitfinex as well. I find Bitfinex generally has traders who've been in crypto the longest very often. It's interesting to compare what they have to say as well. And the way I would approach this long to short ratio is I'd always compare the exchanges. I would start at the 15-minute and I'd compare the 15-minute, right, the more short-term price action. So in this case, we're really long. Then I would look at the 1 hour, okay? So in the 1 hour, we're a bit more short. And I would compare that to the 4 hour and then the daily. So you can see in the 4 hour, for example, here, we're quite balanced. Okay, it's 51% overall, but quite balanced. And the next is the daily, compare that as well. And that's just another approach, really. You can also look at the MDX algo as well. This is that on the 1 hour, for example, there's quite a lot of shorting pressure. And then if you go onto the 4 hour, Binance, is highly short. I keep looking at Binance because Binance generally are retail traders. And the MDX algo, the API is set such that the top trader data is taken out of Binance. So we get to see more retail price action on the Binance long to short. Whereas in this case, Bybit and FTX are generally more advanced traders. Generally speaking, you can see what they're doing. So in this case, you can see in the 1 hour, the Binance retail traders are generally mostly short. In Bybit, FTX, a bit more balanced. If you go on the 4 hour, Bybit and FTX are generally net long. Binance is, again, net short. If you go on the daily, you can see that, again, similar kind of trend. So in this case, I would not be inclined to short. Of course, I would have to get other confluences and other indicators as well, but this to me suggests that, okay, potentially there could be a short squeeze because, as we know, the market likes to make the fools out of the majority of people, really. You can look at things like order flow as well. You always see the habits of retail traders in real time. But one of the caveats I would say with order flow is that just because you see a huge sell order in order flow in vast quantities by potentially a whale, sometimes whales place orders on order flow just to scare retail traders out. So you have to take everything with a pinch of salt. And of course, psychology again, improving shorting. I always have this 3 losses rule. So if I make 3 losses in a day trading consecutively, then I just stop trading. At the maximum, I aim to not lose more than 5% of my portfolio in a day. But it's just to highlight that psychology is just so important in trading. And it's just nice to sometimes just step away from the desk and then trade again next day, just fresh. Another toolbox you can use to improve your shorting is, of course, looking at volume profile. VPVR is good for this. So the setting that I use for VPVR is I put 200 for row size and 100 for value area volume. And the way VPVR works is this. You have these bars on the right-hand side, and these represent areas of high volume. One color represents buying pressure, the other color represents selling pressure, but the exact nature of the colors is not the important thing. The more important thing is how far out to the left do these colors go to. So in this case, you can see the bars go out more here in this region, okay, in the 21K region. Yes, there's more volume here, there's more volume in this region, but the volume kind of tapers up here. And we noticed that price went up here, didn't stay here that long because volume seemed to decrease. Then as soon as price started going down here, the volume started increasing again. So that's just a way you can kind of, another tool to supplement your trading. Generally speaking, price moves from areas of high volume to other areas of high volume. And you also have this point of control as well, so this red line. And that really represents the highest volume node. So this red line represents the area which often has the highest volume in the VPVR. And often price is attracted to that area. And the area can act as a support region from above, or even a resistance region from coming from below. And sometimes if you notice, here in this region, there's a huge amount of volume. And in this region, there's a huge amount of volume as indicated by the amount, how far out these bars go out. But in this middle region, there's slightly less volume. So price seems to have jumped from this region to this region. You also might have noticed this if you're trading Bitcoin. And this kind of coincides with the VPR because you have more volume here. The volume is decreasing here, and the area of high volume is here. So sometimes price jumps up or jumps down when there's a gap where there's a slightly less volume to moving to an area with slightly more volume, as you can see here. Right? And the inverse can happen as well. Sometimes price can decrease but stay for a limited period of time in areas with a slightly less volume and then go back up again to areas with a slightly more volume. So this is just another tool to help you with shorting, really. And if you notice, the point of control also updates as well in real time. So if you zoom out, for example, if you zoom out, the point of control moves to here, 20,276. Yeah, because it's more recent price action. If you zoom out, then the point of control updates again. So in this case, the point of control has now gone to 20,600. And you can also use the 1 hour point of control and VPVR as well. So recently, so for example, the VPVR has been around, in my case, 20,270. I generally would not use VPVR below 1 hour. And I like VPVR using it on the 1 hour, 4 hour, and sometimes you can use it on the daily as well. Because sometimes price is attracted to the VPR, often like a magnet. But generally speaking, to wrap this up, there's two types of shorting. There's trend shorting and there's counter trend shorting. As mentioned before, counter trend shorting is when, for me specifically, I'm trying to short false breaks. And that can be divided into simple false breaks or complex false breaks. But that's, again, beyond the scope of the video. Then there's trend shorting. So I'm just going to draw this to illustrate on the diagram my kind of strategy. I generally use the 4 hour time frame, and then I enter using a break of structure on the lower time frames just to fine tune my entries and get a tighter stop loss. So pretend that this is a downtrend, okay, on the 4 hour. So push up, push down, push up, push down. And I'm going to draw a trend line, roughly. So say roughly there's a trend line going down like this. So this is the high, and this is the low in this case of the 4 hour. I like to draw Fibonacci from the high to the low. And then I wait for a retracement. And once again, I'm looking at reaction of price on a key fib level, or just a key level in general. And I'm fine-tuning my entry to get a tight stop loss and entering. Some people limit themselves and get into the 786, but again, it's all about reacting to levels. I'm not trying to predict where price is going to stop, because if you're adamant the price has to go to the 786, then sometimes price might pull back up to the 0.5, 0.618 and then go further down. You might have missed your moves. It's about keeping an open idea. So in this case, price pushed down, pushed up. So now I saw, again, so there might have been a break of structure the 15-minute, okay? So then I would have entered here. I would have had a nice tight stop loss here. I'm looking for a good risk-reward ratio trade, so I'm going to have a short position roughly here. Again, I'm just drawing this diagram because price action has been so stagnant recently. Okay, so I might have a tight stop loss, and maybe potentially 1 to 4, 1 to 5 risk-reward, potentially 1 to 3 risk-reward ratio trade. Okay, so I've got in here, I've shorted, then price moves down here. Okay, so now I can do the same thing again. So I can move this Fibonacci, and then I can enter another short position on the 4 hour chart. So I can draw this. So now this is the local high. Okay, so I'm drawing Fibonacci to the local low here, and I'm waiting for a pullback to a key fib level here. Okay, so in this case, if you notice, the pullback is to the 382 level and then goes further down. So again, I'm going to enter on a break of structure on the 15-minute chart, just fine tune my entry. So now what I can do then, so once it's pulled away slightly, what I can do is I can move this stop loss down here. Okay. So this initial short position is a risk-free trade. Now I can enter another short position, and it's a short position here. Fine-tuning an entry really comes with experience, and I will talk about it in further videos. But so generally speaking, my take profit is the next key level. So for sake of example, I've drawn a green line here. Okay, so pretend that's the next key level. I also like to have various take profits in between, because the price might not always get to the next key level. So I've drawn a fib here, and as you can see, the next local high was here. This is a local low, then price retraced. So I like to take profit at the negative 0.272 extension, also the negative 0.61 extension, and then also the key level. But I'm always flexible because price might not always get to the key level. Sometimes price might push down like this, okay, and then it might consolidate like this in a key level. So to always be flexible and always react to what price is telling you. Say a price gets down to, say, the negative 0.272 extension and it consolidates like that, I'll be out. I'm not going to be rigid. I'm not going to necessarily always wait for the next key level. If I've already got a good risk-reward ratio trade, or if I have any other strong indication that price is going to reverse, I might get out. And I'm always putting at the stop loss a couple of points above the recent high, because I know if my stop loss gets taken out, then the market structure would have been broken. And so in this case, if we had a run up here, this stop loss would have been taken out, and more than likely we'll have a pushback down, and we'll have a push up, then another pushback down, and then another push back up. So when you've had a big run down like this, and push up, push down, and if you put your stop loss here, very often the stop loss is taken, the higher probability is that it's going to have a push up, push down, push up. It's going to reverse trend. Just to reiterate, I had this short up here. Then once price pushed up and then pushed down, I've moved my stop further down, because I know that if price goes up and it takes it out, then structure's broken. By moving a short from here down to here, I'm also allowing the trade to continue on further down. I'm taking profits in a different way. Whilst I'm not closing the trade, I'm also securing profits, right? I'm a firm believer in the 80-20 rule, in which states that 80% of our results come from 20% of efforts. Sometimes when you play the market structure and you don't rush into taking profits, sometimes you move the stop loss down, you give room to run, and very often in trading, the biggest winners come from a select few trades. And sometimes you need to let those winners run whilst cutting the losers as quickly as possible. So this is the strategy I use for trend shorting. I like to see where the 4-hour chart is going, and then just enter up on pullbacks in the Fibonacci, fine tune my entry using the 15-minute chart, and try to take profit at the next key level, with take profits in between at the negative 0.272 extension and the negative 0.618 extension. I'm responding to price, what it's doing, rather than trying to predict what price is going to do, right? So thanks a lot for watching the video, guys. I hope this video was helpful. The whole point of the video is just to highlight certain mistakes people make in shorting, and hopefully I've provided some tools to add to your toolbox, really. And I'll be posting again, but please do check out my last video. I talk about crypto adoption, risk management as well, which is an important part of trading, and of course my future outlook on Bitcoin in general. And MDX actually comes out as well. You should check out his channel, and he gives his outlook on Bitcoin. He talks about his view on crypto exchanges and the future of those. I also talk about my altcoin strategy as well, and just my general approach to investing. I am a firm believer in active investing rather than passive investing. Passive investing is when you just buy and hold, but active investing is you focus on a unit accumulation. So I talk about that in this video as well. Please do check that out. I've just set up this YouTube channel just to talk about crypto. I'm very passionate about crypto, and just to help speed up people's learning curves, really. So do subscribe to my channel. I've just made it really recently. I made it in the last week, so do subscribe and like, and of course do click the notification bell as well. Because it's such a small channel, you won't really get these videos unless you actually click the notification bell. But yeah, thanks a lot, guys, and I'll catch you in a bit.